Good afternoon, everyone, and welcome to our webinar on single member pensions. My name is Patrick O'Connor, and I work on the pensions team in Mason, Hayes and Curran. I'm joined this afternoon by Jonathan Sheahan, Managing Director of Compass Private Wealth. We would like to make the session as interactive as possible, so you will see a Q&A function on your screen. Please do enter questions as we progress, and at the end we will answer as many of them as we can and as we have time for. If we do not, and you provide an email address, we will come back to you in writing, maybe later today or tomorrow. So just moving ahead to the agenda for today, we're going to look at a mix of topics. We'll be switching between myself and Jonathan. So the need for private pension provision generally, employee contribution limits, the tax advantages of pensions and funding, some regulated and unregulated investment options for single member schemes and post-retirement vehicles as well, such as ours, investment options and strategies, and then financial and retirement planning, and then we'll sum up and have a look at your questions as well. So I will now hand over to Jonathan, who is going to begin by discussing the need for private pension provision.
Thank you very much, Patrick, and thanks to Mason, Hayes and Curran for extending the invite to me today, and thank you all for joining us today on this webinar. So before we get into the technical reasons of why we should have a pension and the technicalities of tax reliefs and investment options, the first question really we need to ask ourselves is, well, why should we fund a pension for ourselves? Well, the illustration here hopefully conveys graphically the difference between livelihoods nowadays and how these days we're living a larger portion of our life in retirement than in previous generations. So ultimately, somebody who's looking to retire now at say 65 will hopefully have 20 years plus, even 25 years plus of retirement to enjoy, but it's also retirement to fund. Because if you look at the bottom left box of this slide, costs of living do actually often increase in retirement. That might be due to inflation as the obvious one, additional healthcare needs, and also helping out children or even grandchildren financially in retirement. The state pension, both the contributory state pension and the non-contributory pension, is about 13,000 per annum at the moment. That alone is obviously not sufficient to fund a retirement, so really the onus is on individuals to fund their own private pensions to supplement and to fund their own lifestyle in retirement. Just on the next slide, I suppose I'm trying to simplify as much as possible that when somebody is working, their outgoings and their cash flow is funded by their earned income. And when I say earned income, it's income from working ultimately, either through self-employment or through employment, PAYE. When you retire, that earned income will generally be either completely eliminated or significantly reduced. So then to fund your retirement years, you become dependent on passive income. And you can't just invent passive income out of nothing. You have to build up a capital base that will ultimately fund your passive income in retirement. And by far, the most tax advantageous way of funding your passive income is by pension contributions in your lifetime. So the next slide then, people say to me, you know, what size of a pension should I be aiming to get towards? And when I tell them 2 million, they say, where did you get that figure from? And I'll never reach that figure, or how exactly do you get 2 million? Well, if you consider, as a high level example, a public servant in the higher paid bracket who's 65 and who has 40 full years of pensionable service in the public sector. And let's say that person's final salary for pension purposes is 150,000 per annum. Well, actually on retirement, that person will receive up to 2/3 of their final salary. So 2/3 of 150,000 as a guaranteed annuity for life. And that 100,000 per annum is ultimately capitalized by roughly multiplying by 20. And that's where the 2 million comes from. So really 2 million then is what the standard fund threshold is. So it's the maximum tax relieved pension fund value. So when we talk about pension targets, that's ultimately where the 2 million comes from. We'll now pass on to Patrick, who speak about the revenue contribution limits.
Thanks, Jonathan. Revenue contribution limits for employees are subject to two main limits. One is the age-related earnings percentage limit, and the other is the total earnings limit. So it's a max or total earnings limit of 115 grand per annum. In terms of the age-related percentage limits, you can see them there. If you're under 30, the max contribution you can make is 15%. Between 30 and 39, 20%, 40, 49, 25%, and so on. Tax relief can be obtained up to the relevant age-related percentage limit in the relevant earnings in any year. Your member contributions are not deductible for USC or PRSI, and if you have for PRSAs, you have a slightly different treatment in that the employer contribution deemed for tax relief purposes to be made by the employee, and it's added to the employee's actual contribution to determine if that overall limit for that year has been reached. If a contribution is paid after the end of the year but before the 31st of October in the following year, relief may be claimed for that contribution for the previous year. But again, you should take advice and speak to your tax advisor or your financial advisor on that. Moving back to Jonathan, he's now going to just take us through the tax advantages of pensions.
Thank you very much, Patrick. So there's lots of tax advantages to pensions. So the way of looking at it really is three ways. There's tax relief going in to a pension, there's tax relief within, and there's tax relief coming out. So starting off with the first point here, tax relief on contributions. The first thing is for corporate pension contributions, there's tax relief at the corporation tax rate of 12.5% on the employer contributions. So it's a saving for the employer in the same way as salary payments would be. For personal contributions, as Patrick mentioned, there's full up to 40% marginal rate tax relief, and company contributions also avail of tax relief from both PRSI and universal social charge. As well as that, a lot of people forget that employer PRSI has been creeping up in recent years and it's currently at 11.05%. So employer contributions into staff or individual pension funds are also exempt from employer PRSI. Within the pension fund, as I mentioned earlier, you can grow the pension up to 2 million. Now, if you look at the little blue box here on the right-hand side, it's a technical point that I won't go into the details of it here, but the actual tax-efficient pension threshold is 2.15 million as opposed to 2 million. Funds grow tax-free within a pension. So if you imagine an investment portfolio or a property, for example, in a pension, any dividends from companies within a portfolio or rent from a property, for example, usually that would be subjected to income tax at 50% rates if those investments were held personally. However, when they're held in a pension, there's full tax relief. There's no income tax, no capital gains tax, or any other investment taxes within a pension. On the next slide then, I'm going to discuss coming out of a pension. And this is where there's a bit more flexibility and complexity, so I won't cover everything here, but ultimately, assuming you're not going to buy an annuity and you're going to move the pension into an approved retirement fund, well, 25% of your pre-retirement pension can be taken in a lump sum. And of that 25%, the first 200,000 is tax-free. So you can retire up to 800,000 tax efficiently because 25% of that, as in 200,000, is tax-free. And the next 300,000 is taxed at a 20% rate. So if you imagine a 2 million pension fund, if you take 25% out of that, that's 500,000. You'll get 440,000 after tax. The remaining pre-retirement pension, the 75% goes into an approved retirement fund. Of the approved retirement fund, a slight technicality, the first 63,500 goes into an MRF, which is locked up until 75 or the full state pension age. Ultimately, the income you take from your ARF is taxed at whatever income tax rate you're paying at that time. That income tax rate for many people is actually lower than when they were earning money when they were working, because there's the standard rate cutoff of 35,000 at the 20% rate. On death, if you're married, your ARF simply can go to your spouse completely tax-free. And if you're unmarried or if you're predeceased by your spouse, your ARF can go to children above the age of 21 at a flat 30% rate. Now, that's not to get confused with the group thresholds for inheritance tax purposes. The ARF doesn't count towards the group thresholds. It's outside of inheritance tax purposes. It's a flat 30% income tax rate. So specific advice might be needed about that separately. So on the next slide, Patrick gave the example of an individual funding their pension in terms of the age-based limits, like a 30 to 39-year-old can put 20% of their income in, all those limits. If you're a proprietary director, so if you own your own company, if you're incorporated, then you can actually avail of, or the company can avail of, very generous employer contributions. And there is no fixed simplistic formula for this. Rather, you need a max funding actuarial calculation carried out in order to figure out how much cash can go from the company bank account into a director's executive pension fund without triggering a benefit in kind for the individual director. And the details that are required for max funding, it's quite simple gathering them. It's your age, your target retirement age. Generally speaking, you can put that to 60 to increase your funding. 60, you don't actually have to stick to that, but a retirement age of 60 rather than 70 will give you more scope for funding. It depends on your existing fund value. So if you're starting at a very low base, the revenue limits are a lot more generous versus if you start with a 1.9 million pre-existing pension, you obviously can put in significantly less. It also depends on your salary. So these revenue limits, you get rewarded for the more salary, the higher the salary you have, because revenue realize that you're paying more PAYE, therefore the funding increases, and also your years of service. Now, the years of service is very important because ultimately a proprietary director can get credit for back service. So when Patrick mentioned the upcoming deadline of the 31st of October or the 14th of November, or even the 10th of December with the new extended deadline, that's your cutoff for personal contributions for the 2019 tax year. There's no real cutoff like that with employer contributions, because if you're paying yourself a salary from that company going back 20 years, you can actually get credit for back service going back 20 years through this max funding calculations. So back on to the next slide, we pass over to Patrick, who will speak about regulated and unregulated investments.
Thanks, Jonathan. There was an issue with my sound there, and so I moved location, so hopefully it improves. In terms of regulated investments, I guess we're looking at what the Pensions Authority has said broadly on investments since the start of the pandemic. It is said, pensions shouldn't look to make immediate investment decisions based on the big market crash there was in March. Obviously led to an incredible recovery as well. Said again, warned against knee-jerk reactions more broadly. Both the Pensions Authority and the UK regulator has warned of the risk of safe haven scams as well, that promise improbable returns, and we've seen a few of those from trustee clients who've brought them to our attention. The importance of member communication for trustees at a time like this is very important. So if there's going to be any delay on fund switching or a transfer value, it should really be communicated, and delays have occurred, certainly given the circumstances. Once a divestment request from a member is accepted or a transfer value is to go ahead, should be carried out quickly and as efficiently as possible. There is some UK case law, Tinconi versus James Hay Partnership, that deals with maladministration by an administrator where a delay was experienced in seeing to and completing a transfer value. the liabilities found to exist in respect of an investment that would have potentially been made had the transfer value taken place in time. Moving on to unregulated investments, which are a very popular category of investment, given their return and value for the likes of small self-administered schemes, ARFs, and other PRSAs as well, and buyout bonds. Directly held property is one of the two I'll speak about today. A lot of directly held property would have been acquired with gearing, and so loan repayments would be necessary. Where there's issues with the tenancy under the legislation, the current legislation is the Residential Tenancies and Valuation Act 2020. That replaces the old emergency legislation, the Public Interest COVID-19 Act, and protections for tenants impacted by COVID-19 will continue to exist until 2021. But for tenants not at risk, a tenancy can be terminated and rent increases are permissible. However, as we move into this further lockdown stage, there is a ban on evictions expected again. I think that's at build stage presently. Where liquidity issues are being experienced, perhaps if gearing was acquired by the pension, so if a mortgage was acquired to purchase the property, to deal with mortgage repayments, it might be necessary to undertake a partial sale of other scheme assets to create greater scheme liquidity. Also, it can be assisted by deferral of trustee or management charges, administrative charges, or broker fees. Under supply. Sorry, I'm not sure what happened there. Undersupply is still an issue in the property market, and of course the pandemic has impacted on construction targets as well. Seems to be an issue with the slides here. Apologies.
I might just jump in here, Patrick. We just have a question that's come in that I might address while we're sorting out the slides. The question is, do we expect indexation on the 2 million standard fund threshold? So it's a very good question, because the standard fund threshold, which is the maximum tax relieved pension size, had been 5.4 million only as recent as 2007. And gradually that got reduced. First it went down to 2.3 million, and it's been at 2 million now for quite some time. So unfortunately, at this point in time, I don't foresee the 2 million threshold being increased, because ultimately all of the pandemic unemployment, the wage subsidy scheme, all of that is going to have to be recouped over the coming years. I don't necessarily think that there's going to be austerity in the way we experienced back in 08 or 09, but I don't think it will be a popular thing, unfortunately, for the government to start increasing the value of the standard fund threshold. I mean, in a lot of ways, it should go up, because the value of assets that comprise pensions have increased over the last couple of years, but at this time, certainly not for the next 2 or 3 years, what I see any way of that being indexed up. I'll hand back over to you now, Patrick, again.
Yeah, I think that's okay now. I think we're back in action. So moving back to unregulated investments and directly held property, generally facilitated by way of an exempt unit trust, which is recognised under the Tax Consolidation Act, and it can only be utilised by pensions and charities. That is a means of ring fencing as well, that asset from the rest of the scheme. It's important to always take advice on the revenue rules for the type of pension vehicle you have, because there are different rules on borrowing and property investments that relate to each different type of vehicle, be it a PRSA or a SAS. Moving on to private company loan notes, loan agreements and shareholding. Loan note defaults of small companies seeking moratoriums have been the theme over the last number of months for single member pension schemes. issues that have been looked at, the cost of enforcing securities in place, getting investor commitment. These investments are often syndicated. There'll be a number of pension scheme note holders, and it can be hard to line up all the investors to get them to commit. As well as that, of course, you have to look at the value of the company's assets and shares, and just have a look at its balance sheet as well to make sure that enforcement, really is worthwhile if you don't have a fixed charge over a real estate asset. Issues that have surfaced, structuring issues, maybe the original terms and security or lack of security that was taken, conflicts of interest, potentially that come to the surface later on that may have existed between an advisor and the investee company, or then conflicts of interest between individual pension investors as well. Advice and due diligence should always be taken, and due diligence has become very important, not just for advisors, but for trustees as well. And of course, the due diligence that was done at the time that an investment was made by the advisor is crucial, really. And that has come to the surface an awful lot, not just during the pandemic, but in the last few years as well. Where you are looking to invest or invest new funds, you might be looking at providing funds to a company that is a small company or a startup that's experiencing debt service issues or working capital issues. Broadly speaking, the pension rules should again be consulted. Ensure that connectivity and arm's length requirements are met. These are revenue requirements again. And beware of the 5-10% rule for private company equity. It's in respect to small self-administered schemes, which states, and it's a revenue rule which states that 5% of the scheme NAV is a maximum that can be invested, and 10% of the issue share capital of the investee company. Due diligence for trustees, as I've already noted, is very topical at the moment with the Berkeley Burke case in the UK last year. It's one of the first times where a trustee was found to be liable, as well as a financial advisor, for allowing its pension members to invest in a company that turned out, or an investment that turned out to be a scam. So I think we're moving on again to regulatory pipeline. The IRP2 directive is expected to be transposed into Irish law very shortly. Some are anticipating it will occur before the end of the year. Others expect that it will be early in 2021, given how busy the department is with COVID-related legislation. The APTI judicial review proceedings are adjourned. So the Association of Pension Trustees in Ireland commenced judicial review proceedings in 2019 that were adjourned against the Minister and the AG, seeking certain confirmations in respect of derogations in the IRP2 regulations for single member schemes. There's an existing investment derogation for single member schemes under the old regime. Where that derogation is not provided, it will mean that single member arrangements will be subject to the same investment restrictions as group schemes under the directive. So this is very much a hot topic at the moment, and that's why one of the main reasons why the regulations are really being anticipated. So moving on to investment options, and I believe I'll hand over to Jonathan again, and he'll begin by looking at the levels of risk.
Thank you for that, Patrick. So just a reminder, the theme for today's webinar is single member schemes. So one of the big disadvantages to group schemes, group pensions, is that your investment options are obviously very, very limited because a trustee has to sign off on them. So usually you might get 4 or 5 fund options in a group pension, and that's it. With single member schemes, you have to remember that the asset allocation and the investment selection is very much the decision of the individual member and their advisor. So it can be completely tailored towards you. And the first thing is to figure out your level of risk. And there's 4 main factors to consider. The first is your age profile. So all else being equal, the younger a pension holder is, the more risk they're prepared to take because they've got a longer term horizon. Below that, non-pension assets. So you need to factor in the value and the profile of your assets outside of your pension in the context of any pension asset allocation decisions you make. So for example, somebody who's got significant cash savings outside of their pension can probably take disproportionately more risk with their pension because you always consider a holistic pie chart when looking at your total asset allocation. And that also includes those of your spouse as well. On the top right, the personal risk profile. So this is something that ultimately the result of this is through a rigorous risk questionnaire where you're asked a series of questions and it's a quantifiable number and it gives you your risk profile, something that we do for all our onboarding of clients. And the bottom right, the view on markets or assets. So this really just depends on a point in time. So sometimes people feel that Irish property is very good value at the moment and I can get an 8% yield, or they may feel that US equities are overvalued at the moment given the upcoming election and where technology stocks have gone. So it's always important to look at the view of your markets at a point in time also when deciding the level of risk. On the next slide, we always talk about diversification in my industry, and people probably are sick of hearing about it and always wonder, well, what do you mean by diversification? Well, you can diversify in two ways. The first, or there's two reasons for diversification rather. One is simply to reduce your risk. So all else being equal, you should be able to participate in the market while reducing your risk at the same time. So it's definitely something that should be done, is reducing your risk through diversification, and also to smooth out your returns. So instead of having like an up year of 25%, a down year of 20%, up 30% down, by having a diversified portfolio, you are really distributing your returns more evenly over the years. And the 7 little factors down here in terms of, well, how do you diversify? Well, you can diversify in terms of asset class, so equities, bonds, property, absolute return, cash, private equity, whatever it might be. Geographical diversification is very important. Thankfully, with technology and pension platforms and all that, most Irish investors at this stage, it's a given that they're diversified geographically. So, you know, as opposed to just investing in Irish stocks, for example, or Irish property, they'd be diversified on a global basis. Investment type, so having a mix of exchange traded funds, maybe some individual shares if you have the risk appetite for that, some managed funds or mutual funds, and maybe some direct property if that's what you like. Custodian provider, I think, is very important for larger pension funds not to have all of their assets with any one particular custodian. Sector in the bottom left, that's very relevant at the moment because we're seeing a lot of people maybe who work in technology companies or who just have had a bias towards what they call the FANG stocks in the US, for example, the top 5 technology stocks, and they've had enormously strong returns of late. But the reality is that they're overly concentrated to that sector, so divesting somewhat. Unfortunately, we saw that with the banking sector in 2008, 2007, 2008 in Ireland, where people had too much of their assets in one particular sector. They felt that they were diversified by having their pensions or their investments split across a few companies. But sometimes the performance of the company doesn't matter. It's the sector, and if the sector's down, unfortunately, you go down. And also a mix between having some liquid and some illiquid assets, and also a blend of both growth and income focused assets. On the next slide, okay, so in very simple terms, the more risk you're willing to take, the higher your target return should be. And the other way of saying that is, the more target return you want, you have to be prepared to take more risk. So in an ideal world, all else being equal, they're completely correlated. Risk and return are correlated. Obviously, you want to find investments that offer a better return with lower risk. But let's assume, you know, from an academic point of view, the level of risk you're taking is going to equate the target return from that investment. So this chart here really is just to show you how, now this is a traditional chart and it shows the bottom left, you've got cash. And as you move up the curve, you're taking on more risk for more projected return. And obviously you're also increasing your likelihood of losing money the more further up the risk you're going. Now, if you can visualize this chart for a minute, and Patrick, if you move on to the next slide now. Now it looks identical, except it has this is the current market. And you'll see that there's now a void in the kind of 0 to 4% target return space. Really what's happened because of quantitative easing by central banks and loose monetary policy is that bonds, so government bonds and corporate bonds in particular, bonds as an asset class have kind of shifted down the curve in that you're now taking still fairly low risk, but your target return is potentially going negative. So for somebody to populate a portfolio with, say, a low to medium risk appetite, unfortunately, the bond asset class is no longer an investable asset as such. So you need to be very, very conscious of that if you are trying to invest, if you're going to invest any capital within your pension in any asset other than cash, you are taking on significant risk. So it's become binary. You're either in cash or you're invested. And if you're invested, you're putting your capital at risk because bonds are now a proxy for cash in the current environment. Just on the next slide, I suppose if I was to summarize, when we look at pensions, we always consider the holistic financial picture of an individual or a family. So before you make any decision on your pension, you have to think holistically. And to do that, step one is understand your current financial position. It sounds obvious, but people often have the habit of jumping on to making decisions, but to spend some time looking at two things: your capital position, assets less liabilities, but also the profile of those assets. How are they split geographically? What's your risk level? What fees are you paying? What's the geographical mix? All that type of thing. So knowing what your capital position is and populating that onto a pie chart so you know exactly what your exposure is. And then from a cash flow point of view, and this is really important in pensions, when you're closing in on retirement age and when to trigger your pension, really knowing what your surplus or your deficit is at a point in time. So by looking at your current income, your current gross income, after-tax income, but also what your future income is. So if you're 63 and you're planning to retire at 65, you have to make note that when you're 66, yeah, you might be getting a state pension and you might be getting some private pension income, but your employment income is going to go to zero. So to know exactly what your costs in terms of cash flows are at any point in time is extremely important. So the next slide then, we've got the quantitative, the maths side of it done, and now it's a softer side of it. And this is where we put the spreadsheets away for a minute and look at, well, what are your goals? And in relation to pensions, the target retirement age is so important. So do you want to retire at 60? If you can work 5 years extra, I assure you it'll make a big difference to your overall finances, because most people actually earn that their highest income, you know, the older they get and the more established they become in their business or their practice or whatever it might be. So look at your target retirement age and stress testing it to say, can I afford to retire at 60? Can I afford to retire at 63? Maybe you can afford to retire at 55. So knowing what that number is so important. You need to know what your desired income is in retirement. So if you want to have if a couple want 100 grand a year income in retirement, you need to multiply that by 20 and get to a 2 million pension pot to fund that 100 grand a year. What are your concerns and fears? That's very important as well. Some people say, Jonathan, I don't care. I do not want any individual stock exposure. I don't want to have any exposure to individual shares. I don't want, other people say, I don't want to invest in property. I don't want to deal with the headache of it. Knowing what your concerns are. Some people have a budget in place to help out the next generation. I'm seeing a lot of that at the moment with you know, young successful adults in their 20s who are earning good money, but with the central bank rules, they can't get onto the housing ladder. So some clients of mine, I'm encouraging them to put maybe ring-fenced pots of funds aside for the kids to help them get on the housing ladder, that type of thing. Also knowing what your own preferences are. So are there any particular restrictions? Do you not want to invest in oil companies, tobacco companies, all those types of things that can be built into a portfolio? What your spending budget is, and also what your, you know, one-off events might be. So often I find people in retirement have a bit more time in their hands and they decide, well, now I'll do the extension on the house, or now I'll go on that trip or whatever it is. So really planning all this is very important. And the next slide, step 3. So we've quantitatively put all of our assets, liabilities, income, and expenditure onto a list. We now have identified our goals, objectives, concerns, risk, preferences, all that stuff. And now you need to simply put it all together with an advisor and ultimately make the most appropriate financial decisions. In relation to pensions, it's being tax efficient, maxing your contributions, potentially deferring the retirement of some of your pensions until 70 or 75. That's a very important point. Just because you retire at 65 doesn't mean you have to retire all your pensions at 65. You can stagger that. And in fact, the longer you defer retiring your pensions, the more tax efficient it is because you're not paying tax on the income, assuming you have the savings there. Asset allocation, the bottom left, you need to, it goes back to what I was saying earlier about looking at your pension and your non-pension together. You need to look holistically, make sure you're not taking too much risk with your overall asset allocation, but equally, maybe you can afford to take more risk. If you've got funds in your pension that you know for sure you're not going to touch for 10 years plus or even 5 years plus, then maybe you should have that invested and risk your assets. On the top right, that's really looking at a holistic financial plan that's specific to you, having a cash flow budget in place. I always think everybody should have a nest egg or an emergency fund to put aside. One client of mine recently liked the idea of taking the state pension into a separate account and just putting it in an inaccessible account until ultimately to fund a future contingency of a nursing home. But having a fund to put aside is very important. There's interest rate arbitrage at the moment. If you've got surplus cash on deposit and you've got any loans that are expensive, then there's arbitrage there. Just use the non-interest bearing deposits to pay off the expensive loans. Succession planning for children is very important. And if you've ticked all those boxes, if you've maxed your contributions to your pension, if you've been as tax efficient as possible, if you've put education funds for the kids, if you have your nest egg, then you can consider setting up a long-term diversified investment portfolio. So the next slide, my final takeaways, if you were to take 6 bullet points from my talk today, take control of your pension and advise anybody around you who you speak to take control of their pension. Do not put the head in the sand. Trust me, it'll be worth it. Really be active with it, understand it. Always think long-term. Second point, with your investment strategy, yes, markets fell by on average 35% in 4 weeks in February of this year. If you have a long-term investment horizon, those short-term volatilities and drawdowns don't really matter. It's time in the market, not timing the market. Holistic asset allocation, I think that's my 3rd time mentioning that today. Look at all your assets holistically is so important. Be tax efficient. I've touched on this already. The government are giving us hugely beneficial tax reliefs for putting money into a pension. Avail of it before you lose the chance. Avoid unnecessary risks. So Patrick mentioned that in one of his slides about certain unregulated investments and not having security over certain investments. You really need to make sure that you're avoiding the chance of losing all of your capital in any one fund. So oftentimes people are, I suppose, attracted to a particular brochure of a fund, may not be regulated by the central bank. And the downside of it might be that you could lose all your money in that one particular investment. So just avoid unnecessary and avoidable risks. And finally, I suppose, in my own industry as a financial planner, we really do see the benefit of clients seeking professional advice as opposed to DIY approach. So do reach out to professionals like Mason Hayes, Curran, and ourselves to get specific advice in relation to your own pension. I'll hand back to Patrick now to talk about his summary slides.
Thanks very much, Jonathan, for that. It's very interesting as well. In summary, just a few points going forward, kind of echoing what the regulatory authorities said and maybe what to look out for as well. Always consider the age-related percentage limits and maximum earning limits when looking at your contributions every year. Continue to be mindful of scams during periods of market volatility as they are out there. And as I said, we have seen a few. When looking at unregulated asset classes, ensure the legal advice is taken in respect of structure and revenue rules. it's crucial to do that because they are something of a quagmire, and there is some difficulty associated with them. The R2 legislation, which is coming down the tracks very quickly later this year, or as I said, more likely early 2021, not only for single member schemes, but for the pensions industry generally, it will bring about a huge amount of change. So that is one to bear in mind. I think there may be another issue with my sound at present, so that's why I've disappeared from your screen. But moving on to questions, we'd like firstly thank everyone for attending, and thanks to Jonathan as well for co-hosting this with Mason, Hayes and Curran. We'll now turn to your questions and just have a look at what's there. So Jonathan, first question is for yourself. What direction do you think equities and markets will go over the coming months, given COVID-19 and uncertainty in the US with the election coming up?
Thanks, Patrick, and thanks to the person who asked that question. I suppose just to repeat, the question is which direction stock markets will go in the short term. Unfortunately, at the moment, more so than any period in my 15-year career in this industry, it's impossible to know which way markets will go in the short term. Traditionally, we value equities based on traditional metrics like your dividend yield, the price to book ratio, price earnings ratio, all these types of things. And it's never predictable entirely, but it's quite easy to see the future of where earnings growth is going to be. At the moment, a lot of those metrics are out the window. So if you think of the earnings calls with PLCs in the US or in the UK or Europe, they're now telling you what the results are. And when they're looking forward to 2021, most of them don't have a clue. So there's so many variables now that are going to dictate the price of markets over the short term. In the next two and a half weeks, we're going to have the US election, and the decision there is going to be very, very, impactful for equity markets. And we don't know which way that's going to go. We don't know when the vaccine is going to arrive. So what I would say is that if you're making investment decisions, or if you're looking at your existing pension portfolio, you really have to factor in the short term. It can go anyway. But if you have a long-term investment time horizon, and I mean 5-10 years plus, then you have to have confidence in, frankly, capitalism and democracy, that equity markets will outperform the alternative, which is cash. So to forget about the short-term noise as much as possible, or as difficult as that is, and always think long-term.
Thanks very much, Jonathan, for that. The next one I think is for me. I sort of answered it already. It's what is the 5%, 10% rule in respect of private company investment? Just to clarify, it's 5% of the pension schemes NAV and 10% of the private companies issued shares, that would be the proposed investees' shares. While it is in the pensions rules, it's strictly limited, or it is limited to small self-administered schemes. Generally, trustees will apply it to other vehicles like PRSAs, buyout bonds, and ARFs as well. It's just a general rule of thumb that we find by way of policies applied across the board by trustees. That has led, of course, then to a loan note or loan agreement, depending on how the investment has been structured, being favoured. So most pensions that have invested in private companies, the absolute most part, will have invested by way of debt or debt instrument. Now, with the restructurings that we've seen over the last 6 or 7 months, some companies would like pensions to convert to equity or make the loan notes convertible, but in many cases that can't be done, unfortunately. So you're looking at extending the maturities of loan notes, or perhaps redemptions occurring as well for certain amounts, early redemptions, and deals being done broadly as well. But it is very topical, and it's one that Revenue do watch. Okay, Jonathan, I think I have another question for yourself. Can you give some examples of a diversified pension portfolio?
Thanks, Patrick. I might answer that question along with one other question that's just come in as well that's very relevant. Firstly, a diversified portfolio, if you imagine a pie chart, and as many different colors as possible into the pie chart, with each color representing an asset class or a geography. So by spreading your portfolio as much as possible into what we call uncorrelated asset classes, the more your downside is protected. And ultimately, that's what a diversified portfolio does. Another question here, which I think is very important. Somebody asked about splitting your pension funds into different pots, which is kind of related to the diversified portfolio. So one thing I always discourage is that if somebody has worked in a number of different companies, I always discourage them to rolling all of those pension funds up into one, because then what happens is that if you imagine if you have one big pension pot worth 1.5 million, you have to retire all of that at once or not at all. It's a binary decision. Whereas if you had 5 different 300,000 euro pensions, then you can stagger them and retire them separately and take your 25% out on a standalone basis. And one very important thing for somebody, this is a very technical point, but for somebody who has less than 15 years service with a company, they can actually move their pension into a PRSA, and the PRSA then can be split into any number of sub-PRSAs, and those sub-PRSAs can be retired at different times. So it's just a bit of technical pension planning. And just one other question before we finish, before I hand back to you, Patrick. It's just asking here about PRSA contributions. This is very important because of where we are now coming up to the deadline. If you're a member of an occupational pension scheme, so if you're a member of a company scheme, be it a group scheme or an executive pension, you have to contribute, make personal contributions to that scheme first and foremost. Now, if you want to set up a PRSA separate to that scheme, really important point is that it has to be a PRSA ABC that's linked to the main scheme. So yes, the answer to your question is you can set up a separate PRSA, but it has to be a PRSA ABC scheme that's linked to the main occupational scheme.
Thanks very much. I have 2 questions here as well that are linked. One is, how will the IRB2 directives investment restrictions affect single member pensions? And secondly, in your opinion, are single member schemes and unregulated investments and pensions long for this world in light of IRBs2 and the Pensions Authority and Pensions Roadmap aim of pension simplification, rationalisation? Won't we see single member schemes done away with, or at least winnowed? Yeah, I think the authority's aim is to reduce the number of vehicles that are out there and to reduce the number of overall schemes. I think that is known industry-wide. That the IRB2 directive, if the derogation isn't provided for, it will certainly affect single member pensions. Small self-administered schemes in particular will be caught as occupational pension schemes, as they'll be caught by Article 19 of the directive, which says that the scheme's assets must be predominantly invested on regulated markets. Predominantly invested has been interpreted as meaning 51%. So you will have that, but it won't impact on PRSAs, and it won't impact on approved retirement funds as well. So unregulated investments can still be done. I think they still have a place. I mean, there was another question further down as well, which said, why are you speaking about different investment strategies instead of just a default or lifestyle fund? I think we're just pointing out the different things you can do and the different things that members tend to favor, and going through some of the options there. Certainly unregulated investments are very popular and continue to be because of the the perceived positive return over some other regulated assets, and certainly cash or bonds at the moment. So it's risk of return is, I mean, Jonathan obviously has been through this already, but that's a big part of it. But I don't think we'll see the end of unregulated investments, maybe down the line certainly, but not for the next few years. However, I do think we're on the road to seeing fewer vehicles, fewer pension vehicles out there, and I guess the pensions world being harmonized and simplified as well for members. Okay, I think that's it. I think that's all we have time for. As a matter of fact, there are a number of other questions that we will look at, and we will respond to you when we have a chance in writing, certainly if you provided your email. Thank you very much for joining everyone again. Thank you, Jonathan, and we'll hopefully speak to you all soon, and enjoy the evening and the rest of the day. Okay, take care.
Thank you.